traders and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, stocks have rallied after strong U.S. retail and jobs data, bolstering hopes of a continued soft landing. We're now joined by Paul Jackson, Global Head of Asset Management Research at Invesco, and Bloomberg MLive strategist Noor Al-Ali. So thank you both for joining us. Noor, yesterday was a big day. Finally, I don't know whether it's finally, because the market seemed to be a little bit all over the place, but certainly today they're pricing in this Goldilocks scenario.
Absolutely, Francine. And it's all on the back of that data dependency that the Fed has given way to. Now markets every day, they look at every single data point that's out there. And based on that, they've decided after yesterday's retail sales, which were much better than expected, that strength of that U.S. consumer that continues to spend is enough for them to see those stocks rise again. It's almost as if last Monday was a really bad dream that we've all forgotten about.
Yeah, we've all forgotten about it until we haven't. Paul, are you expecting a lot more volatility? Is there a danger that actually markets latch onto one thing and then the trades start piling in and 2-3 days later they could all be unwound?
Yeah, I think we're in that time of year when volatility tends to be higher. There is a seasonal pattern to volatility. If you look at the VIX, we've just come out of the period when it tends to be at its lowest and going into the period when it tends to go up and be at the highest. And obviously at this time of the year, markets are thinner. So, yes, they will get buffeted by data going in one direction or the other. And exactly, we've seen that in the last 10 days or so.
So, but what's our expectation for Fed? Again, a lot of market participants think that, the market is actually ahead of themselves in terms of the number of cuts they're expecting.
I suspect the Fed is probably making an error, so I think once it starts cutting, it will probably go fairly quickly, and that's the history of Fed cycles. If you look at recent rate cutting cycles, in the first 6 months, the Fed has cut rates by maybe 180 basis points. Yeah. I don't think they'll go that quickly this time, but I think in the next year we could see 125, 150 basis points of cuts, starting in September, probably with 25.
Noor, when you look at some of the data points, what's the next rendezvous of that markets will be on tenterhooks to see what the Fed decides?
Well, look, we've had a lot of data this week. We've had CPI data, retail sales, a lot of it as well, in the UK and in the US. Next week, though, we go back to that policymaker venue. We've got Jackson Hole coming up. So there's going to be a lot more emphasis on Friday and what comes next in terms of how policymakers are thinking about this latest stretch of data that we've gotten. Now, markets seem to have come to terms with the idea that they might have gone a bit ahead of themselves when they priced in a 50 basis point cut from the Fed in September. Now, whether or not the Fed complies with that is no longer the case, because if you're looking at market bets or swaps tied to that meeting date, you'll see that now they've come closer back to the 25 basis point cut. So a quarter point cut from the Fed is expected, as the other peers are. Now, when the Fed comes out next week and they say, well, look, we're not as worried about a recession, and that will probably translate to us adopting a much slower pace, that's actually going to be good for stocks. In a scenario where, we're not worried about the economy yet, we're still doing very well, and that's the data that supported this. So that will actually revive that sentiment that we've seen, especially in the low volumes, that Paul was just talking about as well.
Paul, if they do a 25 basis point cut in September, does it, first of all, just mean that they can cut and no market event happens if it goes smoothly? But also, do they have a narrow window because of the U.S. election? So they don't necessarily want to do anything in that cycle to November 5th?
Well, it would be very unusual if the Fed cuts rates in September. Normally, after August, the Fed doesn't change policy in the run-up to a presidential election. So doing it in September this year would be very unusual. They then don't have another opportunity until after the election. So they do it in September or they wait until after the election. But I doubt that a 25 basis point cut would have much of an impact on markets.
So do they have to do it to kind of show that they can do it? Otherwise, they risk being behind the curve.
Well, there is that, but I think also now that Donald Trump has suggested that if they change rates before the election, they're going to be messing with the election, then maybe they have to establish that they are independent, especially given what Donald Trump is saying about how he would like to have his hands on the interest rate decision process. So maybe just to be bloody minded, they will go ahead in September anyway, when in previous election cycles perhaps they wouldn't.
Well, treasuries have actually behaved orderly in the last, let's say, 10 days.
Yeah, absolutely. And you see a lot of the movements that we've seen in markets have actually been translated in that risk sentiment. But really, yields are still, we're still at the front end. We're trading around that 4% mark where, there's still a lot of emphasis here on that bond market rally. I've long held that bonds are back. And every time I am defeated in my call when I see those yields rising again. But I do point out that the Fed easing cycle is beginning. Whether they start by a half or a quarter point in September or November, those cuts are going to come. And once they start cutting rates, it'll only translate into better returns for those yields. And so lower yields essentially for treasuries. It's just a matter of when rather than if. And at the moment, we are seeing that stocks are actually doing a much better job at pricing that expectations than bonds. And I think it's because bond traders have been bitten one too many times by policymakers saying we're going to cut, we're not going to cut. And so when we're thinking about how traders are assessing this, the stock market appears to be responding more to that data emphasis. And also we've got earnings ahead, NVIDIA, in just 2 weeks. So a lot of positivity here for markets to cling on to.
Yeah, and we had retail sales. I mean, again, NVIDIA, there was a huge sell-off last Monday when it comes to tech stocks. But how do you position yourself in equities, Paul?
Well, I think it's a tough one because I believe that if you're looking at market cap weighted US indices, S&P 500, for example, it is expensive. And it's expensive because of let's say, the Magnificent Seven, because of their elevated valuations. But there is a lot of enthusiasm around these stocks. So the momentum is there, but I'm just naturally very suspicious of pricing that is so high. So I think there is a lot of good news in that market at the moment. So I'm actually quite wary. And actually, yes, I believe that bonds are back. And for the first time in a long time, I went overweight government bonds in my model asset allocation back in June. 10-year Treasury yield around 3.7, not so attractive, but around 4. Yeah, I think that's okay.
What do you do with Japan? I mean, if you look around the world, Japan is probably the most interesting story that we've had in the last 6 months.
Yeah, and frankly, I think just as I was talking about excessive valuations in some parts of the US stock market, there is an excessive valuation in the yen, but it's extremely cheap. And that is because the BOJ didn't tighten while every other central bank was tightening very aggressively. So the yen has lost a lot of value over the last few years, and I think the yen will eventually rebound as the BOJ continues to tighten and particularly the Fed starts to ease. And with that rebound in the yen, and I think there's quite a rebound to come. We've seen a little bit of that already. With that rebound in the yen, I think Japanese stocks will suffer. And again, we have seen that over recent weeks.
And Noor, we have this great story on the Bloomberg terminal that's actually getting quite a lot of traction. So, the carry trade that blew up the markets last week is now attracting hedge funds again.
Yeah, absolutely. It's just all a matter of positioning right now. And so, when you do think about how the Bank of Japan came out last week and said, okay, well, maybe we won't raise rates if that market turmoil is there. And that's really eased those concerns in the stock market that Paul was talking about. You have seen the Topex rebound a little bit. You have seen Japanese stocks come back up. And then that inverse reaction in the Japanese yen. But ultimately, as Paul points out, there's this overall a belief that the yen has really lost too much of its value already. And in a cycle where that's shifting with the BOJ raising rates while the Fed cutting rates, the current valuation of the yen trading at around 147, 150 against the dollar is still quite low. And there's a lot of room for that trade to unwind. Now, how far the carry trade has to unwind, you've had a lot of, people tell you, well, JPN came out and said just earlier the week it was about 70%. Other people have different odds of it. And it's really hard to tally this, right? Because that move has persisted for quite some time, a couple of years now. And so that takes time to unwind, especially with hedge funds and a lot of volatility and uncertainty when it comes to that rate dynamic.
Thank you both for joining us, Noor Al-Ali from Bloomberg and Paul Jackson from Invesco. Now, we'll have plenty more, of course, on the markets throughout the day. Also coming up is Walmart lifts full-year guidance. We take a look at the health of the U.S. consumer. That's next, and this is Bloomberg. The conversations that matter and the insights you need. This is The Pulse and Francine Lacqua here in London. Now, Walmart shares are flat pre-market after soaring yesterday on raised sales guidance for the year. So the retail giant is gaining market share as Americans prioritize spending on essentials and cut back on luxuries. Well, Dasha Afaniezeva, a Bloomberg consumer goods reporter, joins us now. So, Dasha, when you look at the underlying strength of the U.S. consumer, where does Walmart fit into this?
Most of Walmart's growth has actually come from the higher income consumer. So they've quite definitely pivoted to that and targeted people who are up for convenience and who want a greater assortment of products and therefore are willing to pay more. On the lower end of the scale, it's an acknowledgement that the consumer is stretched and it's a promotional environment because they have been cutting prices. So it's that sort of dual track approach that tells us that the lower income consumers are very stretched. So consumer goods companies and retailers can only really find value at the other end. I think also they've got a really strong e-commerce strategy, and e-commerce has grown 20%. And the private label, that's actually an opportunity for them to win. They've been pushing that.
But Dasha, so if you look, at other companies, Pepsi, Nestle, they've complained about the state of the U.S. consumer. So how did Walmart actually buck that trend?
So they've followed the strategy of kind of pursuing the higher income consumer and going really strong on e-commerce, going really strong on lowering prices. They've also had the strategy of AI. I think it's interesting. A lot of the consumer goods companies I cover talk about how AI is this massive game changer, but Walmart is one of the few that's actually given a data point for what it's been able to achieve. It said that it's created or improved 850 million data points through AI, and that to be able to do that in the same time frame, you need 100 times more staff, which I thought was really, really interesting. And then that's allowed them to sort of predict what people are going to want and allowed them to have lower inventories. All of that's added up to growing sales, to growing operating profit faster than sales, which is really quite a feat if you're cutting prices and if the consumer is indeed stretched.
Dasha, so interesting. Thank you so much for joining us, Dasha Afaniezeva, there, Bloomberg consumer goods reporter. Now, let's go to China. And China's convertible bonds were once considered a safe haven, but now they've been rocked by once unthinkable defaults. Now, let's get the story from Bloomberg's Justina Lee. Justina, great to speak to you as always. So why are Chinese convertible bonds selling off?
Yeah, I mean, all year we've been talking about weak sentiment in China, but in the case of convertible bonds in particular, they've been plagued by fears of default. And that's because we had the first ever case of non-payment earlier this year. And since then, there have been a few other cases. And there's also a unique dynamic with convertible bonds, right? Because they're like a bond where you can convert into equity. And we've kind of seen this interesting case where, because the Chinese policymakers are now saying, if your company's market cap is too low for too long, they're going to delist you. And so there are cases where the small cap got delisted and that affected the convertible bonds. And you can kind of understand that as an investor, if you see that the bond and the stock have both been delisted, I mean, you would definitely sell in a panic.
So, Justina, what does this tell you about investor sentiment in China overall now?
Yeah, I think it just shows us that sentiment is still very weak, and there just is not a lot of appetite for taking risk right now. I mean, we talked earlier this week about how Chinese economic data are stabilizing, but not really turning it around. And I think the concern for policymakers is that sometimes that psychology can take hold, and that, if people keep wanting to stick to, the safest assets. They're not buying these convertible bonds. I mean, it's further shrinking the financing channels for a lot of these small cap companies. And, and that's why the government is also worried about people kind of piling into sovereign debt, because they feel like that rally has gone too far. But that's really kind of what a lot of people feel most comfortable investing in right now.
Justina, thank you so much. Bloomberg's Justina Lee there with the very latest on China. Coming up, the first case of the new Mpox strain is recorded outside Africa. We'll have all of the details next, and this is Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Sweden has reported a case of the new Mpox variant, the first recorded outside Africa. Bloomberg healthcare reporter Janice Q joins us now. So, Janice, what more do we know about the case?
In Sweden, the case patients had recently traveled to Africa, and specifically to the region where the outbreak is happening most quickly and the strongest. They sought immediate care when they returned to Stockholm. Apparently, the authorities are saying that the patient doesn't need further infection control measures, but they are saying that they take this specific variant very seriously, and they will continue assessing the situation and see if other measures are needed.
So tell us more about wider containment efforts and the risk of border closures.
So both the Africa CDC and the WHO have been very, very clear. They do not think that borders should be closed. We saw with COVID-19 that it's not a particularly effective measure. Once something is moved, it's moved, and closing something retrospectively is not particularly useful. There's also a huge risk of economic fallout, and specifically in a region like the DRC and other parts of Africa, that is something that no one can afford. So that is not something that is recommended. Of course, it doesn't mean that no one will do it. We got news from China this morning that they are surveilling all incoming transport from Africa, so flights or boats. Nigeria, just on the continent, Nigeria has said they're also upping their surveillance. And last month, Ivory Coast actually reported their first case of this particular variant. And I'm just going to read to you what they're doing because it sounds quite dramatic. So they have invited anyone keeping live animals without proper authorization to hand them over to the nearest forest service station or risk facing up to 20 years imprisonment and a fine that equates to about $166,000. So countries are taking it seriously.
But Janice, I mean, and again, a lot of people will be, afraid. A lot of other people will say, we're making mountains out of nothing. The concern here is that this is a changing virus, right? So that it's not airborne, but you could still catch it if there's a bit of saliva if you're speaking to someone quite close. So, how fast can this new strain spread, and how many versions are we likely to get of this?
We don't have that data right now, and scientists are really scrambling to get more. Surveillance in the most affected area, which is Eastern Democratic Republic of Congo, is not. It's a very tricky area to work in, and so. It's been circulating there, this particular variant's been circulating there for at least 8 months, possibly longer. And the cases are very high there, both, and deaths, actually, more than 500 deaths in the DRC alone this year. So they are scrambling to get that information. It is still something that we will probably get more information in the coming days and weeks.
Yeah. Thank you so much. Our Bloomberg healthcare reporter there, Janice Q. Coming up, we speak to the chief executive of Five Guys in the UK and Europe on the fast food chain's appetite for expansion. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Global stocks rise with growing optimism that the U.S. will avoid a recession. The Euro STOXX 600 is heading for its best week since May. Ukraine says it's accepting the surrender of the largest group of Russian soldiers since the start of the war as Kyiv continues its cross-border incursion. Plus, Sweden has recorded the first case of the new Mpox variant outside Africa a day after the WHO actually declared a global health emergency. Now, on to things maybe a little bit more fun to talk about. After 3 years of food price hikes, U.S. and European consumers are voting with their wallets. Now, pressure on the sector has led to supermarkets and fast food chains offering more promotions and deals, including McDonald's in the U.S. launching a $5 value meal. Now, here in the U.K., Five Guys, which has more than 1,900 locations worldwide, has continued its expansion despite uncertainty around the economy. Let's discuss the outlook for the industry with John Eckbert. He's chief executive of Five Guys in the UK and Europe. John, thank you so much for joining us. A lot more fun talking about burgers and milkshakes than anything else that's going on in the world right now. It's going well because you're expanding.
Yeah, so Five Guys, we have 270 stores in Europe now, 170 in the UK. We'll be opening about 50 stores a year. So at $1 million to $1.5 million investment per store, that's a significant vote of confidence in the future here in Europe.
So what's your biggest concern right now, or what's top of mind of things you worry? Is it planning? Is it staffing? Is it food price inflation? Well,
of course, the UK consumer and the European consumer has been under a lot of pressure of late. And how do you provide a value proposition to the consumer in this market? And the good thing for Five Guys is that we have the highest value for money fries, for example, in the business. The generosity, ounce for ounce, is the best.
I mean, in terms of quantity.
In terms of value for money, right. For the fries, competes with all the QSRs, for example. So, providing customers with great value for money. Five Guys has a lot of free stuff as well. We have free peanuts, free refills, 15 free toppings. So the headline price may be higher than the QSR, but when you add it all up, the value proposition is pretty compelling at Five Guys.
Is it worrying for your margins? I mean, given you also pride yourself of saying you provide very high quality ingredients that I imagine have gone up quite a lot in terms of expense in the last 3-4 years, but you haven't passed on that to consumers.
Yeah, so for other brands, the playbook, whenever you have an environment like this, would be to shrink the product and to compromise on the quality of the ingredients. And of course, Five Guys would never do that. So we have to focus on providing fantastic customer service along with the great product. And Five Guys is a treat. So you're not going to go to Five Guys every day or multiple times a week necessarily. So when you go to Five Guys, you want to have the best burger you can have, fantastic customer service, great milkshakes, and perfect fries. So we've got to focus on making sure that you get that.
So, and it's true, you go around the country and actually go and quality test. So every day you're having multiple burgers or multiple bites of burgers just to make sure that they all taste the same.
So we're very operations driven, and I'm fully certified to make burgers and fries. I can cook your burger next time you come in. And being able to know our standards and cook to standards. We don't have timers. We don't have any cook to order. We have to actually know the standards that we're cooking to. So we're all certified in the kitchen, and that's really the focus of the business is on burgers and fries and taking care of hungry customers.
Is it, is staffing an issue? Are you finding enough people that want to work?
Yeah, of course. Having great crew is so important. In the food business, it's all about passion because you want to know the people who are cooking your food actually care about the product that you're getting. So making sure that we have people who are not only certified to make the product, but actually care about the food that you're going to be eating is essential.
But John, competition must be high. I mean, there's like a talent war, even for like waiters and people that are at that high standards. Do you have to pay more? How do you retain them?
Yeah, so first of all, we pay more than the minimums. So we pay more to start with, and every time you learn something new at the business, we increase your pay as well. We also have invested millions into learning and development. So we can take you from a crew member to being a senior leader in the business with hundreds of employees working for you. So that learning and development journey is something we've really take pride in. So 75% of our store managers come from our crew base now. So that's part of the journey we've been under.
Is the UK market different to other European markets? So do people buy and consume burgers and fries differently on the continent?
Every country is a little different. But we're surprised by every country that we open in. We just opened up in Portugal in the south of Spain. Did 170,000 pounds in the last week in trade, which was 3 or 4 times what we thought we would. We just opened up in Wembley, which we thought all of the kind of high volume sites in the UK would probably have been done. But when Taylor Swift played, we did 180,000 in a week worth of business there. But when Harry Styles takes Olivia Dean for a burger to a Five Guys, that really helps and drives people in to go, that's something to try.
So are there any new countries that you want to be in Europe?
We're going to open Portugal next year. So we're looking at Lisbon, looking for a prime pitch site. We always want to open up in a kind of flagship location. So we're looking for the perfect site in Portugal.
We have a number of very talented food critics here. And I remember 2 years ago, it was all about the burgers. I mean, there were a number of burger chains that were opening in the UK because it was a hot new thing coming from the US. Is the space still very crowded, or is it less crowded in Europe compared to the UK?
Well, a number of the US better burger brands have come to the UK and opened and then closed shop and gone back home. We've been very fortunate that we have been able to open up in pretty much every pitch in the UK, and that's really given us a great defensive position. And now across Europe as well. We have 35 plus stores in Germany, France, and Spain as well, taking those prime flagship locations for the better burger segment.
Do you use AI or tech to streamline and to get better customer orders or better service?
We haven't figured that out yet. We are looking at kiosks for the first time because we wanted to be as famous for customer service as we are for great burgers and fries, and we weren't sure, do kiosks really fit into with that strategy? But there are a lot of young customers, particularly, who really want a digital experience. Our best till operator is no competition for them for a great kiosk. So we're providing that digital journey now and investing in that strategy.
But kiosk, it's less expensive for you, I imagine. But I feel like everyone is doing it.
It may be, but we're not doing it for that reason. We're doing it to delight the customer. And there is a customer subset that wants a digital journey.
I mean, indulge me. Who's your perfect customer, apart from the celebrities that can bring other people? Do you
18 to 35-year-old looking for either something fun to do in an evening out, some place to take your family when you're shopping, going to a movie? All those are great occasions to think about Five Guys and go for a burger and fry.
Do you feel like you need to have a healthier proposition because of everything that's going on in the I guess, nutrition world, right? Even the Nestlés and Unilevers are trying to cut calories to give customers a healthier journey.
We're working hard to come up with some better alternatives to the burger and fries, but we want to make sure that it's the same caliber quality so that when you come in, you go, that's best in class. So we're not going to offer anything until we're confident that we have that level of product. But we do, and we will extend the product line of the business.
Do you have a say on the new products that go online?
Well, the Morel family, there actually are Five Guys, and they actually have to approve anything that we would serve. But we're working hard to convince them.
Any closures?
We have closed one site in Le Havre in France, which was, I guess, a casualty of Brexit. But other than that, we're opening stores rather than closing them.
And has it changed the way there's been a little bit of a pattern that's taken a lot of people by surprise, post-COVID? It's people went out a lot more, and now people stopped going out. I mean, is it going really fast? I feel like the cycle of how we entertain and go out changes rapidly.
No, it has. And we are social creatures in the end, and people going out and being able to be together again has been a powerful trend. And it's been great to have people back in the stores for us, because seeing your food cooked in the open kitchen and being there with your friends and family makes a huge difference for us.
Thank you so much for joining us. That was John Eckbert, the chief executive of Five Guys in the UK and Europe. We'll have, of course, plenty more on the retail and hospitality business. For the moment, this is what markets are doing. There's been a bit of a rally, and that's really on the back of what we saw from U.S. data. Now, coming up, Ukrainian troops continue to advance in Russian territory, with Kyiv saying they captured over 100 Russian soldiers in a single day. Details next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Ukrainian forces say they've accepted the surrender of the largest single group of Russian soldiers since the start of the war over 2 years ago. Bloomberg understands that 102 Russian servicemen were taken as prisoners of war on Wednesday. Now, Russian officials have already contacted them about a possible prisoner swap. We're now joined by Bloomberg's Tony Halpin with the latest. Tony, we're entering the 11th day of this operation. How do Ukraine and Russia view the situation on the ground now?
Well, Ukraine's top army general told President Zelensky last night that they were setting up a control point in the town of Sudzha to administer to the needs of the local population and keep order. And that suggests very clearly that Ukraine's planning a longer-term stay than simply a raid in this area. Russian authorities also yesterday were getting increasingly concerned about security in the neighboring Belgorod region, which suggests that they also fear that there will be an expansion of Ukrainian attacks and reaching into that region as well. So generally it seems that Ukraine, as you said, is expanding its hold on this territory, digging in, and it's for Russian forces to try to find a way to restore order and demonstrate to their population that they've regained control of the border. So far they haven't managed to do that.
So, Tony, what are Ukraine's allies making of the turn of events?
Yes, the Pentagon said that the US was still trying to understand Ukrainian objectives as part of this incursion, and it's clear that a lot of allies are looking at this and wondering what that means for the longer-term outcome of this war. Ukraine has been long arguing that they need to be able to use long-range weapons against Russia in order to increase the pressure on Russia, bring Russia to the table for a negotiated end to this war. That argument is being revived now that Ukraine has entered Russian territory, and so far we haven't seen the sort of response that many allies in Europe and the US feared if this particular red line was crossed. So there's a lot of discussion about what this incursion may mean for Ukraine's longer-term strategy in bringing this war to an end.
Yeah, so what do you think it means? I mean, again, there are many questions about, this was bold. Is it trying to show something to Russia, or is it's difficult to really understand the end game?
Yeah, it's been highly unexpected both for Russia and for Ukraine's allies, and it clearly demonstrates a boldness and an audacity in taking the fight to Russia after 2.5 years of effectively defending itself against the Russian invasion. There are theories that abound. One is that Ukraine may be trying to take territory in order to trade it when they come to the negotiating table with Russia for territory in eastern Ukraine, where fighting is continuing and Russia is slowly advancing on some of its objectives. Other theories are that this is an attempt to really increase pressure on Vladimir Putin inside Russia by demonstrating that Russia is vulnerable and to make Russians question the purpose of this war now that hundreds of thousands of Russians within Russia itself have been turned effectively into refugees in their own country.
Tony, thank you so much. Tony Halpin there with the very latest on Ukraine and Russia. Now, Gaza ceasefire talks are underway in Doha between Israel, Qatar, Egypt and the U.S. in an effort to cool tensions in the region. Although Hamas representatives are not due to be present, officials say mediators will brief the Iran-backed group shortly after the gathering. While staying with Gaza when the war finally ends, attention, of course, will be firmly on the Gaza Strip. And the biggest question of all will be, how can it begin to recover? Let's discuss all of this with Bloomberg's Fadwa Hodali, who, together with the team, has been working on this piece that's come out today. Fadwa, the war in Gaza has left a staggering amount of rubble and unexploded weapons scattered across the enclave. When can we start talking about rebuilding, and who would be the parties involved?
Well, we can start talking about rebuilding is when we have a complete ceasefire. Without having a complete ceasefire, none of this will take place. First of all, we have to have a complete ceasefire. Then the teams will have to go inside the Gaza Strip, evaluate, come back with a report, and then the process will start. This process is very complicated. First, we have a lot of explosive ordnance under the rubble. There are estimates of about 20,000 bodies and remains are under the rubble. We have a contamination of the soil. So this all requests an expert to evaluate the situation. And once there is a plan and once there is a complete ceasefire, immediately this process will take place. But also there's another challenge. A challenge is when you have a ceasefire, you have to have an agreement for the borders and the crossings to open because you need machinery. And without the machinery, none of this could take place. You have 80% of the machinery inside the Gaza Strip that have been damaged and destroyed. And you need new equipment. And without the approval of the Israeli Authority, none of this could take place.
Fadwa, it is really unimaginable, as you say, the estimated 20,000 bodies remaining under the rubble. And UN humanitarians estimate only that will take up to 15 years to clear this debris. So is that the most intense challenge?
Well, the removal of the rubble and debris goes into stages. First stage is you have to clear the way for the Gazans to come back to their homes. And by them able to come back to their homes, you have to clear the explosive, the remains from under the rubble. And then once that is done, then the process will start. This could take a year, but it could take longer. And I'm saying a year, that's if enough funding is available and all the resources and the machinery and the crossings are open and the teams. So you have to have this magnitude of work being done in order for the process, the first phase to start. Once that is done, then, the estimates, they said 15 years, but actually it could take less than 15 years. It could take up to 7 years if you have enough funding, enough manpower, crossings are open, machinery can enter into the strip, and you have a way of finding where you're going to put all that rubble, because that rubble is contaminated, and you have to have the approval of neighboring countries. What are you going to do with this rubble that is contaminated? What are you going to do with it? So this is a very, very complex case that needs to be taken care of, and it has to be done. Actually, now they're working on it before the ceasefire takes place. Because once the ceasefire takes place, right away, there has to be an agreement by all sides working into this. When I'm saying all sides, meaning the UN agencies, UNDP had put in a lot of effort in previous years, in previous wars, coordinating this with the donor country, with the Palestinian Authority, and of course, Israel was involved into this. So I would imagine with the scale of destruction this war have put, of course, coordination from all parties is needed. And what's needed is a complete ceasefire for this process to start.
And Fadwa, also, do we have any estimates on how much, once there's a ceasefire, the rebuilding of Gaza will cost? And who steps in to try and fund some of that cost?
Well, the estimates, we're talking estimates, about $80 billion from estimates. And who's going to step in? All donor countries have to step in. I don't think the issue of the funding is a problem. The problem and the challenge is making sure that the crossings are open and this process can take place without any obstacles and challenges. So all donors, all UN agencies, Palestinian Authority, everybody will have to chip into this process so it can make it happen.
Fadwa, thank you so much for joining us today. That was Fadwa Hodali there with today's big take. I urge everyone to go and read it. It's called Gaza Reduced to 42 Million Tons of Rubble. What will it take to rebuild? And this, of course, comes on the back of this U.S.-backed ceasefire talks restarting in Doha. There has been more and more calls to reconstruct the strip. Coming up, Catastrophe bonds power past last year's record as temperatures in Europe surge. More on the cost of climate change. That's next, and this is Bloomberg. Italy and the Balkans are on red alert, and Greece is bracing for more wildfires, with temperatures forecast to climb as high as 42 degrees next week. Now, the situation in the region is said to see the issuance of catastrophe bonds power past the record set last year. Well, joining us now is Bloomberg's Eamon Farah. Eamon, is this summer actually out of the ordinary?
Yeah, this summer we have had extreme heat across Europe. You talked about, temperatures exceeding 40 degrees in Spain and France, and in the UK we even got up to 35 degrees on Monday. Now, this summer, last summer, the summer before, these all seem like out of the ordinary hot summers. So it seems like the extreme heat anomaly is becoming more and more of the norm. But yeah, it is pretty bad this summer as far as heat goes.
So where has extreme weather and heat been actually focused?
So yeah, Greece, the Balkans, definitely has been a focus of the heat. We've had some days where temperatures could be 10 or so degrees above normal levels, but also southern Spain, parts of France. I mean, basically, when you look at the list, everywhere has been hit by extreme heat at some point over the month of July, whether it be Paris, London, Athens, Madrid. Millions of people are feeling the effect of extreme heat in their lives.
So, what is the impact of the weather and heat, and what are the financial implications of this?
I mean, the impact is wide-ranging. You have the impact on your health. It can be, physical health, mental health. When temperatures don't drop very low overnight, that can really impact older people. But also, as you said, there's a financial cost as well. When it comes to wildfires, that is creating huge issues, especially in Greece. You had a huge area outside of Athens where, a lot of forests and a lot of buildings were destroyed. At the same time, we have this kind of catastrophe bonds, which are possibly getting to record levels. Now, in Europe, they aren't as mature, this whole system of catastrophe bonds, which provide an insurance mechanism against wildfires and other natural disasters. The models behind them aren't as mature, but we could see them becoming much more important as a way of kind of, financially being resilient against these more and more frequent extreme weather events and wildfires.
Eamon, thank you so much. Eamon Farah out there with the very latest on this pretty terrible weather. Now, let's also look at what European stocks are doing. What a difference a week makes. I mean, it's incredible that the flurry of data that's been spurring optimism that the U.S. will avoid a recession has now put U.S. stocks on course for their strongest week of the year, where last week was actually mayhem. Up next, a Bloomberg Brief with Manus Krani in New York, and this is Bloomberg.